Good day, everybody. This is Jim Kinney for the Option Professor Weekly Market Update. Of course, this is January the 18th, 2019. And as I always start out with, the past performance is not necessarily indicative of future results. And short-term trading, option trading does contain substantial risk of loss and is not right for everybody. So do consult with your clearing firm, yourself, your advisor, and anybody else might be reasonable to do so with before you do anything, okay? Quick background on myself. I'm Jim Kinney, the content provider at Option Professor, and I'm also a graduate of Boston College. I've been in the investment arena here for decades, and I've educated thousands upon thousands of people at my live option learning seminars. What I'm going to do today, as I do every week, is give you my opinion and my views on a wide variety of areas and try to shed some light on what's going on in the marketplace. Quick review. Obviously, last year, we went way up into an overbought condition, both on valuation and in price on the stocks. And of course, at the end of the year, that overvaluation and that extended technical situation got wiped out pretty fast. And we went actually into an oversold condition. Now we are snapping back to the upside again. I'm going to go over some key levels here because maybe some of the sledding is going to get a little bit more difficult than the quick, big snapback that we've had. So let's take a look at some numbers here, and I'll give you an idea of what I'm talking about. Today, you can see we closed up 336 points on the Dow Jones, and the NASDAQ was up 72. Let's turn to the S&P, and then I'll get into some numbers so you can get an idea. Again, when the market is very, very high, I always suggest to people to investigate collar strategies and married puts to protect your assets against big market declines. Had you investigated and possibly used some of those tactics when we were up at the high levels, you'd be a happier person today. When the market goes into the tank and you feel like you've got good companies, but you're afraid of all the cash risk you're taking, sometimes people investigate buying long-term calls like leaps and replacing their stock with limited risk calls. Obviously, if you did that at 23 or 2400 on the S&P rather than panicking out, you'd be happier again today. Again, if you have any questions on strategies, either protecting your assets or replacing risk with limited risk options, again, my email is optionprofessor@gmail.com. OptionProfessor@gmail.com. So please shoot me an email with any question, and I'll get back to you on that. Okay, so let's take a look at the S&P, and we'll give you a quick rundown here. S&P 2670, the high was 2675, another big day. You know, again, why would the market be rebounding so fast? Well, first of all, order imbalance is a key when investing. When you go from 2800 to 2300, you best believe that the sells coming in outnumber the buys that are coming in by a ton. Now, after you've sold out the market from 2,900 to 2,300, you think most people who wanted to get out have done it, and you think a lot of the panic selling may have been done. So after all that selling is done, obviously, if people want to do some buying, is there going to be a less of an inventory of sellers down there? Of course, because you've already sold out everybody. Now, of course, you had a lot of buyers and short covering. You think anybody shorted the market on the way down? Well, now they want to cover and take their profits. That means they've got to buy. Who's going to sell into the abyss? Obviously, not too many people. And then you go up to 2,500. How do you go to 2,670? You go up to 2,670 because they start talking about how the Fed is on pause. And they start talking about how earnings aren't that bad. And then they start talking about the Chinese U.S. agreement is coming down the pike. And that's how you get up towards 2,700. How do you get through 2,750, 2,800, and back into a bull market? That's yet to be seen. And that's why as we come into this neighborhood, which I'll show you in a minute, you have to be somewhat careful because some of the easy lifting may have already been done. Obviously getting sellers at 2,700 or 2,750 may be far easier than getting sellers at 2,300. Okay, so let's take a look at a couple of things. There's a thing called the Fibonacci number. One of them is around 61%, 61.8%. If you take the top price at 29.40 and you take away the 23.46, 61% bounce back from that drop from the high to the low brings you into right around 27.10. ballpark figure. Obviously, the market's still underneath that, so it's still underneath the Fibonacci rebound. Now, the moving averages, that's a key factor to me because the moving averages are based on time and price, not opinions and not panic or not anything else. Now, again, when we were up at 2,900, the 200-day moving average was in the 2,700 area. That's why we call that overbought. Now, where are we at? We went all the way down to 2,300. When the moving average is at 2,740 and you're at 2,350, that's very oversold. And that's why you're coming back. Some people are suggesting that if you got caught in the big rainstorm to the downside, the rebound rally might be your opportunity to rebalance your account. Ray Dalio was quoted as saying, if you're very happy when things are up and very panicked when things are down, you're probably out of balance. So this rally could be an opportunity for people to rebalance. At any rate, you can see we did pop above the 50-day moving average this week when we broke above 26.26. However, the 200-day average is still at 27.40. So my feeling is somewhere between 2,700 and 2,750 might be a neighborhood where this market may roll over. I'd monitor that very closely. And if I had any big gains that I had off of this rebound rally, I'd probably start considering collar strategies, which is an out-of-the-money call, and taking the premium and buying the put. And that brackets your equity on this big rebound, and it puts some stability into the risk reward relationship on your ownings. So that would be something I would look at as we get into this area that we're just in right now. Again, big move to the upside. And again, three things are the earnings, again, which will continue to come out, have been received better. And again, a lot of the markets were way down. Let's take a look at something like Goldman Sachs. Goldman Sachs came out with some information. Their takeover merger and acquisition business was quite strong in the fourth quarter. And let's take a look at why that might have bounced back. Okay, first of all, we'll take a look at the chart. And you can see it's in a very big downtrend. I mean, it went from 170 down to 270 down to 150. What's that about? Getting to be about a 40% drop. Okay, but let's look at the moving averages and see where they were. And we'll see right now, by the way, most moving averages still have the death cross, 50 underneath the 200-day. This thing crossed over the 50-day, just like the S&P, but look above, 220, 200-day average, sitting you right in the face. You're at about a 10% jump from here, and you're going to run smack into the 200-day moving average. So you can see we've had a nice bounce back up, another typical situation where you were oversold. When it goes down to 150, right, and you're at 220, on the 200-day moving average, you're $70 underneath the 200-day average. That's 32% underneath the 200-day average. That's hugely, in my view, oversold. And that's why you're getting the bounce. So you don't sell into the abyss and you don't buy the top of the Empire State Building. Avoid those two extremes if you can. Okay, and how do you know when they're extremes? You don't know. How do I feel that they're extremes? When they get egregiously far away from the 200-day moving average. Okay, because sometimes they tend to gravitate back towards them. Okay, so the financials are having a nice big rebound rally. Again, Goldman Sachs is an example of having a big rebound rally, but still being well underneath its 200-day moving average. So again, don't forget, when all of this, and you have the January effect. Every Tom, Dick, and Harry in the financial services industry is telling people to put their money back in stocks. And obviously, with the stocks rising right now, their story is going to make more sense to people than if they tried to sell it at the end of December. So bottom line is you got people reinvesting their IRAs and their 401ks and pension plans. You've got a situation where the market was very oversold. You've got a situation where the chirping about the Chinese and U.S. trade deal is picking up. In fact, China was out there today saying they're offering some 6-year buying spree, I read, to ramp up imports by $1 trillion to wipe out our trade deficits by 2024. A lot of people are skeptical because our appetite for their goods is quite strong, and ergo it could be difficult to do. But there is some chirping out there, and it wouldn't surprise me if some kind of a deal is met. Let's talk about another key thing right now. which is interest rates. The Treasury note. And here's what I have been reading and hearing that I happen to hook onto a little bit here. The 10-year note right now is at almost 280. Can you see the rates are rising again as far as the yields? They got way overdone as well because everyone was saying we're going to this big recession. We're probably going into recession, but it's farther down the road, and they hit the panic button a little too early. So the bottom line is that you went from 325, which was an overbought condition, on the 10-year yield. You went down to 255, which is an oversold condition, and now you're probably going to gravitate, in my view, if you can get above this 280 area, back towards 3%, where there's a little gap there in the chart. Now, with regards to why would the Fed pause? In my view, as I read the tea leaves, the Fed is pausing because they're trying to let the dollar drop. Let's see what the dollar's doing now, because it had been declining. US dollar. Here you go. Let me get the right symbol up. That's always helpful, right? One moment, please. There you go. So the US dollar index, you can see, bounced back up a little bit because yields went back up. But I think that they would like to see the US dollar, which was up near 98 and dropped down towards 95, maybe decline a little bit so that what? So that the economies can grow a little bit, the emerging market can grow a little bit, because the dollar has been very strong, as you can see, going from 88, 90 all the way up to 98. And now it has rolled over a bit, bounce up rally here towards 96.50. And if we take out 95, you can see that there's not much underneath it until 94. And then after 94, it could go into the abyss pretty good. So in the next year, it's possible that the Fed, by pausing, could cause the dollar to drop a bit because it's been supported by higher interest rates. If that happens, then the Fed would have, because if the markets get pretty good and the economic numbers come out pretty good, then the Fed can get to that neutral level faster, and they can go back to their hiking situation because they don't have to hear about how the stock market's dropping while they're trying to get back to neutral. Okay, so as I see it, I still think there's a potential for a yield to rise later in the year, and I still think there's a potential for the dollar to have some decline later in the year. We'll have to see exactly how things work out. With regards to, let's go through a couple of other markets right now, like the oil, XLE. That's the ETF for oil. You can see it's been trying to rally up. And, when a market goes from 80 down to 50, it's an essential market like energy. There are some things that raise their head that could have some value. Now, I'm not recommending this per se, but I'm going to show you something that stuck out to me when we hit around 40, when we hit about 40 something on the crude. There's a closed-end fund by BlackRock, and the symbol's BGR. And I'll just give you an example of why this stuck out to me, because it dropped down to $10 a share. And I went on a 10-year graph. I like to look at things in different time frames. I'm giving you a little bit of a hint on some ways that I look at things. If you look at it on a 10-year basis, you get an idea of the longer term structure here. Now, this thing is a closed-end fund. When it hit $10 here recently, the net asset value versus the price was at a 15% discount to the net asset value, meaning if you liquidated the things that are in the fund, the price would be X, and the price in the open market was 15% underneath that. That's not bad value. What that is a product of is, with closed-end funds, it can trade up or under the net asset value because it's a fixed amount of things in there, and then the rest of it is just people wanting to get in and wanting to get out. Now, to get an idea how badly they wanted to get out when oil hit 40, look at the volume here, way over 2 million. And look how many normally where it's trading now, 237. So that's a big give up, right? And look at the 10-year here. It hadn't been lower than 10. 15% discount to net asset value. You're trading at 10, and the distribution level, you see the yield, was over 9%. Now, that's what you try to do, is you try to find things that you believe are being thrown out with the baby in the bathwater, and you realize that, once things settle down and people feel like the world's not coming to an end, these things will have value, because a solid distribution and a discount to net asset value and a $10 price, which is near a 10-year low, might not be a bad time to take a bite. And so the bottom line is that's an example of how to look for value during crises and try to come away with something while Santa is giving away presents. We don't never know that Santa is giving away presents. You got to take a risk when you do it. But the bottom line is if you have a checklist and the checklist looks pretty good, it may be time to take a bite of the sandwich. All right, let's take a look at some other things going on here. We went over the energies thing. Let's look at, we went over some financials. Of course, they're having a bounce back and everybody's in love with them again. But let's not forget, the yield curve could be inverting. That means these people are going to have to pay higher on their deposits. Their loan demand was nothing to really write home about. And so the bottom line is that, the profitability of these banks looking forward may not be as good as they have been. You got to be a little bit careful. And again, if you look at the XLF, which is the ETF that people use as a proxy for the financials, let's take a look at where the moving averages are on it and see if the 200-day is still declining, which I think it is. So here it is on the financials. You've got the 200-day moving average at 26.88, call it 27 bucks. So you're still trading a little bit above it. And of course, the 50 is underneath the 200-day. So these are all reasons why you have to be a little careful. Now, listen, if you get above the 200-day and it can maintain above there and they can turn the 50 to get above the 200-day, then you got to get back on the bull train, in my view, because then the technicals are turning back up. Right now, you're getting a very, very contra-trend rally, and you don't know how sticky it's going to be. Only time will tell how sticky it's going to be. So keep an eye on that as well. Consumer discretionary, I'll look at a Vanguard fund. The consumer is supposedly well employed, and the consumer is supposedly out there spending money. And so that was another one that went from 180 on this all the way down to 140. Now you got 3.7, 3.9% unemployment. A lot of people are out there working. And so that means they got money in their pocket. So maybe shorting the consumer all the way down there was a little bit overkill. And now you've bounced back up. But let's look at where the 200-day moving average is and see what the line in the sand might be so you don't get caught buying the top of a rebound rally, which is the distinct possibility of what you're looking at. Now, that's at 166 and change. So we're getting close to the averages. And I would say that in the next 2 weeks between now and month end, we're going to probably have to see if we can take out these 200-day averages. 2740 on S&P, 166 on the Vanguard Consumer Discretionary, 27 on the bank, the financial XLF. We're coming in. That's why I say the easy sledding may be behind us, and we'll have to see exactly how easy it is to get through some of these resistance zones basis the 200-day moving averages. Let's see how utilities are doing real quick. And then I'm going to go into stocks that are in the news. This is the Vanguard utility. Great place to hide during the drop in October, November, December, right? Great place to hide. Look, there you got October right here. So between October and December, the thing went from 115 to 130, 127. Not a bad place to hide. Getting 343 yield and your principal's going up. But after it started to roll over, and it kind of rolled over in kind of a big way here, boom, down, it's kind of going sideways a little bit now. Again, if yields are going to rise, it would be not that great for utilities. Let's look at the 200-day average because it could be something to keep an eye on. 116, 118, right at 118. You start trading underneath 115, and that could be problematic for utility. Let me give you a couple of other things real quick before we get into specific stocks, and these are other things that I'm looking at. Let's look at the transports. If they lose confidence on moving goods and services, that could problem as well. Now take a look here, and you can see again a big drop, 11.5 all the way down to 8,800, 86.36, right? Big bounce back here, right? But where's your 200-day moving average? I'll tell you where it is. It's around 10.5. So the sledding from here to here might be very easy. Getting above 10.5 or 11,000 might be a little bit more difficult. So be careful not to just run in and buy the rebound rally, because if it does fail from up there, you'll be the proud owner of the high price of the rebound rally, and that's not an owner you want to be. So again, good rebound out of the transports, still resistance on the 200-day right above. And again, we'll have to see if there's a stickiness to the rally, meaning can this rally stick? Or is this going to be something that will dissolve by the end of the month if the news changes at all? We certainly got a lot of stuff out there between the investigation and between the shutdown and all the other stuff. So there's plenty of balls in the air, and they may not all turn your way. So you got to be careful out there. Okay, and then let's look at the last thing, the VIX. Being an option guy, always look at the VIX. My feeling on the VIX has always, well, not as always, but currently has been this. When you're above 25, you're in the red zone where there could be a risk for a meltdown in price. Can you see when you got above 25 here? Boom. You see when you got 25 here? Boom. Got above 25 here? Boom. So when you're above 25, you're in the red zone, and there's a risk of a going into the abyss type thing. When you're between 17, where we are now, and about 25, I think the market is generally doing pretty good and generally stable to higher between 17 and 25. More like 17 to 20 is the best area, 15 to 20. Now, if you get under 15 and even under 16 or so, underneath these lows, then I think the market would be very positive, in my view, and that would be indicating that the volatility is subsiding because the market is trending and staying higher. So if this thing is going to be a sticky rally where you're going to be able to see this market continue to rise, you're probably going to get that VIX underneath these two lows, and then I think the sailing might be quite good. Otherwise, can you see we're pulling back right to where they bounced out before? And when they bounce out, the market drops, right? Bounce out, drop, bounce out, drop. So be careful down here because you're getting close to a neighborhood where it has been near a high point and a turning point. Okay. So again, that's why I say if this thing does not get through the 27, 27, 40, 50 area on the S&P, your collars, the out of the money call, buying the put with the premium, not a bad strategy to investigate. And again, work out the numbers, work out all the ramifications of the strategy, talk to your financial advisor or anyone else who's helping you with it and your clearing firm, and then deal with the appropriateness of it at that point. Okay, so now let's take a look at a few stocks and see what's going on. Apple, big stock owned by many, got hit hard. This is a classic case of when it got way overbought at 233, and once it starts dropping, why not the collar? Out of the money call, buy the put. Sell the 240 call, you buy the 220 put, bam, you're protected at 220. Not a bad place to be. You're getting scared out of the market here at 140. Why not consider possibly replacing long stock positions with long-term calls? At least it's limited risk. And if the thing's going to be able to turn, that's good. Problem I see is these guys don't want to announce iPhones. iPhones, I thought, was 60% of their revenue. So I think that's a problem. Saturation on the iPhone is very, very big. And $1,200 an iPhone, it might be out of the price range for most people who want to buy a phone. So there's a few factors out there, and they're trying to become more of a service company. I don't know if services are as profitable as making these iPhones or other products that they have. So there are significant problems, but it is a very oversold market down here a bit. Let's look at your 200-day average so you have that right in front of you. 200-day on Apple might give you an idea where it might be trying to get back to. Yeah, 190. You're way oversold. You're $50 underneath 190 at 140. That's going to be what? Almost 25% underneath. That's pretty good amount oversold for a company like Apple. So that's why you're getting a little bit of a turn here. You get up towards 160, 170, 190. You know, I would be a little concerned about being long on that rebound unless it can stick. But that technical damage on some of these markets has been significant. All right, let's take a look at another one here, which is Tesla. Tesla is actually now acting as if they're sobering up, talking about cutting their workforce, cutting the price on their cars, and apparently all these cuts also they forgot to tell you they're going to cut the price by 13% today. So again, Tesla is another story. They have some convertible bonds coming due with a price of 360. So if the price is above 360 when they come due, that would be another liability, I believe, for the company, and that might be one of the another reasons why they may have been able to talk this thing down a bit. That's a pretty big gap down. Somebody's giving up pretty good, but this company can be all over the place. Look, 390, boom, down to 240, bam, up to 375, bam, down to 300, boom, right to 360, boom, right back to 300. So if you don't have a seat belt on this car, you're going to get probably thrown through the windshield if you're on the wrong side. Again, when you're way up on Tesla, the collar strategy, sell the out of the money call, buy the put, lock in your gain, and that's another way of doing it. But this company is on the defensive now because Elon Musk, rather than talking Fantasy Island, is now talking reality, job cuts, and cutting prices on their vehicles, among other things. Okay, what else do we got out there that might be interesting here? Would be let's take a look at Netflix that came out with their earnings. And let's see how that looks like right now. Netflix at 339, down 14, down 4%. They tried to rally the stock today, acting like it didn't matter, up to 353. By the end of the day, it definitely did matter. It was down at 339. Again, they've got a lot of expenses coming from trying to make their own content. I guess it's not cheap to make these Hollywood movies, etc. And this company is having problems like that. They do have some pricing power. According to some people, people don't notice their bill that much. So hiking their bill a little bit is obviously a strategy that Netflix might be doing here, and that could obviously add, some said, $1 billion to the bottom line. So that's a very positive thing. But there are gaps technically here at 300 and 275. And if the news does get people sobered up, it's possible that you could see the market rebound back. Don't forget, it went up 50% in a month. So, anything goes up 50% in a month is a pretty big deal. And this is a $154 billion company. So we're talking about a lot of money. Now, the 200-day moving average, where are you? It's at 332. Do you notice it kind of went up above it a little bit, and then it's coming back down toward it a little bit? The two numbers are still inverted. So this is kind of a sloppy technical picture. And that's why using the collar strategies and married puts, if the economics make sense, meaning the price of the options or what you're receiving makes sense, would be the way to go. All right, let's see what else is going on. Remember, we said that the dollar was rebounding a little bit, but it could run into some problem later in the year. Well, if that is to occur, maybe some of the gold miners will be able to get back on the bicycle. I would imagine they pulled back a bit lately, and have. So again, when I was bringing it to your attention originally, it was down in the 17 and the 18 area, and it had a nice big run up here, but it ran into some resistance right around 21.5. You see these lows there? Can't get through it. You get above 22, 23, and there could be a significant major advance coming. So keep an eye on that. You start getting above 22, start getting above 23, this thing could have some big future in it if it's combined with a weaker dollar. And some people say there's an inflation scare coming. Let's face it, 3.9% of the employment. You got wages rising, pretty darn good. And a lot of people are trying to pass on higher costs in Q1 here. So if they can pass higher costs on in Q1, it'll show up in the CPI numbers a little later in the year. And if the dollar drops and the CPI start rising, then this thing could get on the bicycle. So keep an eye on this as part of your portfolio. All right, let's take a look at again the Treasury situation here. A lot of people are in bonds. Again, the big rebound in high yield. But again, high yield rebound may also be short-lived. Be careful, because as we get into this year and next year, there's going to be some refinancing that has to be done with these very, very low-priced instruments that they have to refi. And that means you could be looking at covenants that could be looked at. And if their balance sheets are not up to snuff, it could cause additional problems. Again, we're getting a little bit of a rebound in yield. Nothing to write home about. You get above 290, and then, of course, it'll bring 3 into play. And if you get above 3, then, of course, that might bring the whole uptrend of rates back into play. Keep an eye on that, because, again, the recessionary talk and the negative talk seems to be a little bit premature. Again, there is a lot to talk about. I invite you to every Friday, we're going to have this available to you. If you have specific questions for me, again, I encourage you to email me at OptionProfessor @gmail.com. And I also encourage you to invite friends and associates to take advantage of this every Friday. And until next Friday, I want you to wish you all the best this holiday weekend. And I'll be with you next Friday. Let's see how it all works out. And until then, good luck and good trading.